This is our Forex blog for August 1st, 2011. Today's a very exciting day for us because not only do we have incredible statistical tools that show you the strongest currencies to buy and the weakest ones to sell. For example, the yen last night, extremely strong. All the daily, weekly, monthly trends are up, and from 3 to 11 it was clearly one of the strongest. The pound consistently was one of the weakest today, and so was the CAD. So basically you want to sell the weak pound against the strong yen. Now, normally in the past, we've done this, with either tick charts, 5-minute charts. Let's bring up the 5-minute chart of the pound yen right here. I'm going to illustrate one of our new features right here in our video blog for the first time. Here it is on a 5-minute chart. Now, as it starts to trend down really violently from 6 to 9 o'clock, where do you get into this downtrend? And where can you get into this downtrend with the least amount of risk? The key to trading is small losses, bigger wins. Doesn't even matter if you're right half the time. If you have 3 times bigger wins than losses, you can make money being right only 40% of the time. And on these strong trends that keep going and going, when do you get in? I mean, this just kept going and going. Currency meter clearly shows you that. Now, in the past, we've had tick charts, 50 tick, for example. This downloads tick data, and every 50 price changes, it updates the chart. And it's not a bad improvement over the regular time-based chart, but notice how far we have to scroll back in order to see this chart. It maybe started its downtrend right here. There are a few entries into this downtrend where you have, it breaks that little sideways range here, and your stop is above the high. You have this little pullback right here. So tick charts improve the 5-minute chart when you have these super strong trends like this. But the downside of that is you have to scroll back a long way. Even though price wasn't moving that much during this hour here, it took up a ton of bars. Now the third option is something called a range bar, where each bar is a certain number of pips. And in order to put these on the chart, let's say you want to see 6 range bars, 6R. Instead of 6 or 50T, 6R. And this, each bar is 6 pips. And notice when the market's moving around right here for about 2 hours, you have less distance on your chart than you did with the 50 tick chart, but it's also extremely clear, where to get into this trade. Strong move down, here's your first pullback, another move down, it goes sideways, you might sell the low right here. You have a 3-bar pullback. 3 and 4-bar pullbacks seem to be really high probability, low risk places. And because each bar is only 6 pips, if you put your stop 2 pips beyond that, you're risking 8 pips, or even add 4 more pips or 2 more pips, you got a 10 pip stop. And when you see a lot of price action where it goes up, down, but it doesn't really move a much range here, from 9:30 to 10, notice how few bars there are here. You can have a very tight stop, and there it goes. Compare again to the 50 tick chart from 9:30 to 10. Notice we have to go back a lot. Here's 9:30 to 10 on here. Lots more bars. So and a lot of low volatility noise shows up on the charts, especially right here. It didn't even move at all, and we got 20 bars right there. So the more volatile the currency, maybe the bigger the tick bars you want. Maybe you want 9 range bars for the pound yen today because it was so volatile. But you clearly have, here we have a strong trend down. This was a very decent 70 pip pullback. You have your trend line break right there. The first red bar, you go short, and you can see it fell back, 60 or 70 pips. Even if the only trade of the day you took was this little sideways range right here, your stop is at 94, you went short at around 78, it pulled all the way down to 38. Or even if you got out, on this green bar right here, you made 25 pips. It's very clear with a range bar. And notice a lot of activity from 10 to 10:30, but during the dead times, from 4:30 to 7, there's not as many bars. So, it's very clear by looking at this, where to get into the trades. You have the 50% pullback right there, and a bunch of green bars in a row. The first red bar, you go short, your stop's right above the high. With a 9 range bar, if you wanted a 13 pip stop, you could add 4 pips padding to it, and after every bar, you can put your stop a few pips above or below the previous bar's high or low, and you control your stop down. Also, some of the tools that we don't use for a while seem to work really well on these range bars like MACD. I don't really use the MACD, but notice it goes short and it keeps you short for about 100 pips there. It seems a lot more accurate on range bars than regular bars. And also the parabolic, which I don't use that much, but it does seem to be very useful on range bars. Short here, small profit, short here, 30 pip profit, short here, 150 pip profit, short again, another 50 pips. It's, because these update after each bar closes, it yanks the stop up, and it's a decent entry and exit method, especially when you use our currency meter to find the strongest and weakest pairs. And for those who trade longer term and you want to see bigger moves with less bars, normally you'd use hourly or 4-hour charts. Maybe with this you'll use a 50 range chart. Now you can really see, in some cases many weeks back, what the action is. And you can clearly see the high had a false breakout and then it came back, tried to go higher and failed. You got this 350 range, fell 50 pips, went up 50 pips, fell 50 pips, short here, read your stop. For longer term traders it's very clear, and especially when you're in the strongest trends, you oftentimes get these big moves. So that's a little preview of the range bars that we're releasing today. The euro was relatively strong until about 6. The yen was weak until about 3. So before 3 you could have actually bought the euro yen. Let's bring this up on the chart. Now keep in mind the euro has extremely weak longer term trend, and the yen's longer term trend is strong. You would have been better off trading the euro against another currency that was weak. For example, the pound. The euro pound would have been a better and safer buy than against the longer term strong yen. Let's bring up the euro yen just to show it. Before midnight, price was above hourly here, and if you bought little pullbacks right here. Now this is another good example of how to spot longer term trends using the new range bars. Bring the euro yen up here and maybe put a 6 or 9 pip range bar on here. It's got to download all the tick data, and we'll just start with a 9 range bar. When the market's volatile, you have big moves. Now here's the beginning of the day. This is one that you wanted to buy starting the day off. You got a nice little pullback right here. You go long. You might have even bought this little pullback right here. And notice, the clarity that you have on a range bar. It's not time dependent. Went right to the fib targets, ran out of steam. And, when it came down and double bottomed, it didn't totally double bottom right here. You might have went long after multiple red bars in a row. It comes up, kind of runs out of steam right there. And once it made a lower low, you go short, and it pretty much keeps you into the trade, very clearly. Especially when you have a super weak currency, a 2 or 3 bar up move, and it looks better on a 6 range than a 9 because there's more bars. Anytime you have a 3 or 4 bar up move, it's usually a pretty decent place to sell on a strong trend. So you have a strong trend, 3 closing bars up, 1 down, you go short with your stop right above the high. And anytime you see a little sideways action like this, you can just yank your stop down. It's a very high probability trade. Also, many times wicks at the high of the bar tend to signify a reversal. Here you have 2 bars up and a wick, very low risk probability. Stay in it until the bars are green. You got a 60 pip move right here. So during active times, this is a really low risk, high probability place to trade. Here you have a strong trend, 3 bars up, 1 down, you go short with your stop right above the high. And you had a little bit of a whipsaw here sideways. You're in that trade really early. Would you have taken that trade here at 8:19 on the 5-minute chart? Let's look. Here it is at 8:19. Doesn't look nearly as good. Usually in the past, once a currency is kind of trending down, I wait for it to go sideways for half an hour, then I'll sell a sideways rectangle. So I would have gone short this maybe around 75 on this chart. But going back to the 6 range bar at 8:30 or 8:19, whatever the time was. It's a little farther back here. You'd go short right here at 92. So you're short at 92 versus 75, and the market's kind of going down. 2 bars up right here. You might lower your stop right above there. Then you jumped the gun. You got into this trade with an extra 17 pips, and also with a tinier risk. If you went short right here, the logical place to put the stop was right above the sideways consolidation at the whole number, plus maybe 2 pips. You had to risk 25, 27 pips there. Getting short with it right here, you put your stop right above the consolidation high, you're risking 10 or 12 pips. So anytime you can have the same accuracy or better with an 8 or 9 pip stop, or 10 pip or 11 pip versus 25, you're going to automatically improve your trading.